Wall Street can sound like a zoo when you talk about all of the bears and bulls, wolves and ostriches, sheep and chickens and pigs and other animals. What's going on here? My name is Ashton, and welcome to Market 101, where we break down the basics on economics, finance, and of course, the market. I have a list of 10 animal-themed terms that investors use on Wall Street. It turns out that animals are a pretty great illustrator for complex market principles. First, let's talk about the most iconic and recognizable pair, bears and bulls. You may have heard about the bull statue on Wall Street or seen the terms used in headlines. Bulls are optimistic investors and think the market will rise higher, like a bull raising its horns up. Bulls are known for charging ahead with their investments. Likewise, the stock market can be described as bullish when stocks continue to climb, defined specifically as when the market has risen over 20% for 2 months. But where there are bulls, there are also bears. Bears are the opposite. They are pessimistic. They think the market will go down, like a bear striking downwards with its paw. A bear market is defined as a downturn of 20% or more by the major indices for over 2 months. And if a person is described as a bear, that means they think everything is downhill from here. It's a hawk! They watch the interest rates and inflation with a hawk's eye. They're looking for tighter controls on money supply and prefer higher rates to keep down inflation and prices. Doves, on the other hand, flock towards easy money and prefer lower interest rates. They're more tolerant of price inflation, believing extra money circulation is good for the economy. Remember what you were called when little Timmy triple dog dared you on the school playground? Chicken.
You're chicken.
Same thing in the world of investing. If you're chicken, you're scared. Chickens would rather sit on their current portfolios than make any changes. They don't want to risk it for the biscuit. On the other hand, we have pigs, and they like to take big risks. They go all ham. They want to rake in as much cash as they can in the shortest time possible. Pigs are considered synonymous with greed and impatience, and often they'll lose their bacon. Now picture the big bad wolf from any fairy tale you grew up with. They're sneaky and up to no good, like wearing a sheep's clothing or blowing down straw houses. Well, a wolf in Wall Street is an investor who makes money either criminally or unethically. A great example is The Wolf of Wall Street, which is both a book and movie based on the true story of Jordan Belfort, who defrauded investors and was eventually caught and put behind bars. Real ostriches you see at the zoo will bury their head in the sand, and that analogy is used for people who fail to react to crucial situations in the market. Ostrich-like investors prefer to ignore the negative or threatening information and do nothing, hoping that their portfolios won't get hit. Hey, before I forget, comment down below your favorite Wall Street animal and which one you think you are. Let's see how many different animals we can get in the comment section. This phrase dates all the way back to the 18th century London stock market, referring to traders who defaulted on their debt. They are called lame ducks. Lame ducks have huge losses and default on their debts or go bankrupt. So, don't be a lame duck, be a cool duck. Quack, quack. Here in North America, we don't have any indigenous stags, so this may be a new financial term and just a new animal term. A stag is a red male deer from Europe, and like the typical deer, they may be a bit skittish. If you're a stag on Wall Street, that means you're a short-term spectator. You buy and sell stocks quickly, just within a few hours of the day. Stags need a lot of cash on hand to do this quickly, so they depend on small price movements. They do not follow the buy and hold strategy. Sheep are followers. They do what someone else is doing, like their family, friends, or coworkers. They don't make important decisions on their own, and they can suffer from following bad advice or making decisions too late. Bad idea. Instead of talking about types of investors, here's a term to describe a type of stock. If a stock is not performing well, it's called a dog. Buying dogs might not make sense, but the dogs of the Dow theory says that if you buy a dog with the highest dividend yield, you could expect a high turnaround. Of course, That's just a theory, a stock market theory. Don't be a sheep and take this as investing advice. We've talked about dogs, so now of course we have to talk about cats. Except these cats are dead and bouncing. The dead cat bounce refers to a temporary recovery of a stock price that's on its way down. You might think a struggling stock is twitching its way back to life, but then it just rolls over, still dead on the ground. Well, these cats don't have 9 lives, just the bounce. The bizarre terminology comes from the phrase, even a dead cat will bounce if it falls from a great height, which doesn't make it any better, but the terminology became popular in 1985 when the Singaporean and Malaysian stock markets bounced back after a hard fall during the recession of that year. Ever since then, it's been a term used on Wall Street. A weird term. Now that you know all about the animals of Wall Street, you should go check out the top 10 investing terms you need to know.